everybody. We are starting this session dedicated to monetary policy and the implication that monetary policy has in a macroeconomic equilibrium and all the challenges around this process. In fact, all our countries, especially in Europe, are faced with a lot of supply shocks, with geopolitical disruption and problems, but also with a general high level of uncertainties. So this is the macroeconomic context that we are trying to talk about monetary policy in different angles. In countries which are non-part of the Euro system and countries that are part of the Euro system. We will try to analyze if there are differences in challenging macroeconomic issues and problematics in these different institutional status. We are starting with the governor of Bank of Armenia.
So, first of all, I would like to join all of my colleagues and thank Bank of Albania for this invitation. And one peculiar thing is that whenever when I'm introducing myself and telling Armenia, they are always confusing us with Albania. So I'm at home somehow.
But not in this case.
Yeah.
Not in this case.
So regarding the topic that I'll try to cover it's all about new framework that we have introduced at the Central Bank of Armenia for our monetary policy making. So we worked over last 4 years to develop this framework, and that goes to, I think, several comments that colleagues did before. One of the previous speakers talked about small being beautiful. I think that one of the main reasons that small could be still beautiful is that even small central banks could be at the forefront of policy making. So sometimes the best frameworks shouldn't be coming from Fed or ECB, but we may witness the cases where the best frameworks would come from a small or neglected somehow central banks. That would be a case also of inflation targeting historically, coming from New Zealand and then taking over the world. So our ambition was bigger than this world, so we decided to come up with a new framework, which is basically based on analytical framework of new Keynesian model, but we developed it because we witnessed so very big layering of crises throughout 2020 and afterwards. So it all started with COVID, but later on we had war with our neighboring Azerbaijan, and then Russia, Ukraine. So there were unprecedented layering of crises. And then we decided that the system that treated us well before, because we're an inflation targeter since 2006, and we have always delivered on our target. But we realized that the framework that we were using was not serving us well. So we understood that even during the normal times, the baseline forecasts are almost always wrong. And then, if we may have the next slide, I'll show you the picture how wrong we are. So, for example, there was a conversation in US Fed in 2021 when inflation was rising, and there was a tremendous uncertainty whether it's going to be transitory or persistent. But then at the very end of the day, if you look at the dot plot, there was a variation among people who were talking. For example, we know from press and from other evidence that Jim Bullard was against it being transitory, so he was thinking that it's persistent. But that voice was somehow silenced because Fed was coming up with just one storyline, which somehow kept their hand tight. And I think during that period exactly where the Fed lost most of its credibility. That was a very difficult period of time. So we said we shouldn't be relying on baseline, and we should come up with alternative scenarios all the way through. So we forced us to ask a couple of fundamental questions. The first one was what was monetary policy fundamentally about? So is it about trying to predict the most likely future with a degree of confidence, which is what most leading central banks do today? Or is it about something else? And then for us, monetary policy is not about constructing the best forecast or drawing the baseline. It is fundamentally about doing whatever is necessary to prevent the economy from sliding into dark corners or avoiding worst-case outcomes. And then that mindset, because at the same time that we were working, Larry Summers wrote an article in FT, I think, talking about falling baseline. And then we contacted him, and we started developing framework together. And we call it prudent risk management approach to monetary policy. We borrowed the phrase from Alan Greenspan, but Alan Greenspan talked about it, but he didn't develop the full framework. So we said, no. We need to be credible. We need to do the framework job at the beginning. So we first started with understanding the most fundamental question based on risks and development. So the board members, we have 8 board members. Each one is elected by the parliament. Each one is independent. So every board member should ask where is the economy now? Question at the beginning. So to bring an example, in late 2020, when our inflation was below target, we were discussing in the board what comes next because of the government stimulus that we had. And then many of us thought that there will be persistent inflation pressure. So inflation below the target, we increased the interest rates and communicated that with the market, that kind of in a forward guidance way, telling them our anticipation for the future. Second thing is our least regrets. So we don't think in baseline terms, but we think, what if we are wrong? What if we increase the interest rates and there is no inflation? What would happen then? And what if we don't increase the interest rates and there is an inflation? And what would happen then? So tackling these 2 things help us in a way to come up with a framework that we developed. So the prudent risk management approach to monetary policy is very comprehensive. And we come up with policy strategy and scenarios to the decision-making model, which we discussed. And then analytical framework, which includes a robust suite of based-in-case models, which are nonlinear in nature. So this is New Keynesian nonlinear model family. And then we do something that probably we're the first in the world currently doing. That would be best-in-class communication, transparency, and accountability. And then we did something also to the complete overhaul of our HR policy. So we do have 4 teams of 6 economists each. All of them are generalists, and we are rotating amongst teams so they don't get burned out. Regarding our communication strategy, I would mention what we do. The same day that the decision-making happens, we publish several things. So we publish attributed minutes, where market can see what was going on in the boardroom with the names. Second thing, we publish attributed votes, so everyone knows who voted for what. And the third thing, which is probably the most unique character, is that each single board member publishes 1-pager telling her or his stance why they voted the way they voted, trying to explain. And that's the day that we make a decision. So there is a monetary policy report, transparency report, attributed votes, and 1-pagers. Then I give a press conference, and the next day, the team, the monetary policy department team, with one of the deputy governors or the board members, is taking a big meeting with analysts and market participants. So that would be in a nutshell on what we do. Just not to repeat myself, but to make it clear. So we think that trying to do this least regret policy and prudent risk management is the way forward for monetary policy making. We're implementing it fully since January 1, 2025. So it has almost been a year. And I'll tell you that it has served us very well. So we do have a lot of questions, but at the same time, market appreciates that because we give them a lot of food for thought and a lot of insights that come from the boardroom. Thank you.
It's a very interesting the way how you are taking decision on monetary policy. It's much more detailed than the traditional one, having once a month, and it's going much more deeper, right? But why this, if I'm asking this question, why you are doing such a very detailed and also fragmented decision on policy making?
So regarding the framework, I would probably stress two ingredients which would help you to understand. So we're living in a completely uncertain world, and being able to squeeze the entire uncertainty in one baseline, from our perspective, is completely impossible. So I'll give you an example. So we increased the interest rates, so inflation went up, we bring the inflation down, and then we decrease the interest rates, and then Russia-Ukraine happened. So Russia started war in Ukraine in February 2022, and imagine that 2 days after Russia-Ukraine war started, we had a board meeting, and we're sitting in the boardroom, and then Armenia is somehow very much related to Russian economy, and there obviously a simple scenario, which could be a baseline, that things in Russia will go wrong, economy will collapse, there will be a negative external shock for Armenian economy, so Armenian economy will slide, which means that we need to decrease the interest rate. That is something which is obvious. But then several of us thought, what if things go right in terms of economic development for Armenia? What if Russians will flock to Armenia, especially the scientists and engineers? That would be a complete opposite of what we were discussing. That would be a very big positive external shock, which will bring prices up again. And what do you do with that? Okay? So, and then in that sense, you cannot squeeze those two scenarios into one baseline. And we wanted to go out and tell the story that we have discussed. So that was the reason. And then we didn't decrease or increase the interest rate. We waited for a while, and it turned out to be the best economic year for Armenian modern economic history. We had 12.6% economic growth, 100,000 Russian IT engineers arrived to Armenia, and inflation went up again back to 8%. And then if we were going with baseline, and imagine that we were cutting the rates, that would have fueled inflation even more, and we would have gone into inflation spiral. So that's why we decided that the framework that we used to have didn't serve us well from that point. And the second part was about communication. If we discuss it internally, but we don't have means coming out and telling general public and market participants the richness of the story in the boardroom, it doesn't make any sense. So we decided to be extremely open, which gives us this opportunity to communicate with people.
Is it okay? It's quite unique, this way of analyzing and taking decision on monetary policy, because maybe of the just political area when you are conducting your activities, economic activities and non-monetary policy activities. So do you think that it is going to last, or somehow you will be back in the normality? I'm doing all the questions because he's leaving very soon for the airport. That's why.
So I'll tell you that so far the things that we do served us very well. So we've improved our communication, and then market participants like it very much. And so I'm not thinking that we're reversing the course. What I see, it is becoming a general trend now. We had a couple of meetings when I was at the fund during the annual meeting, so I met Ben Bernanke, who did the report on Bank of England, and then I met the governor of Bank of England himself. And then whatever Bernanke has in his 60 pages, I think is completely in line with what we do. And then I think the governor of Bank of England said in one of the meetings that we were talking, he said, you guys are doing what we dream to do. So it means that we're probably turning the course, and my prelude about small countries trying to bring new frameworks might work this time as well. So we do have that ambition to be kind of a New Zealand of 21st century. So we'll see. If we fail, we fail, but there is also a possibility to contribute to general thinking.
Thank you. If there is anybody having a question or a comment on the monetary policy of Bank of Armenia. Yeah, otherwise.
So, yeah, I apologize to my colleagues, and then I need to run. Yeah. Thank you very much.
Yeah. And then we are going on. I would invite for his presentation Mr. Slavevski, the governor of Bank of Macedonia, because this is the second bank which is not a European bank, so in the ECB circle. So just to discuss and then to go back on the ECB banks. So the floor is yours, please.
Thank you, Julieta. First of all, I commend the organizers for this nice event, and also on the part of the National Bank of the Republic of North Macedonia, I congratulate the 100th anniversary of the Bank of Albania, and I wish them to continue with the good work. I have to say that as neighboring countries, with these close countries, our national banks have very close cooperation. From what I hear from my associates who have come to visit and work with their colleagues here, with the staff, they have, just excellent opinions about the organization, competitions of the staff, etc. So the topic of my presentation would be monetary policy challenges in the Republic of Macedonia. First of all, I'd like to, let's say, mention that we have had de facto fixed exchange rate, first to the Deutschmark, then to the euro, since 1997, with the fixed parity. The parity hasn't changed. So I'm a university professor, and I tell my students that there's no mystery how we managed to do that without any, let's say, accumulating of real appreciation. The answer to this question is that we managed to keep our inflation rate within the limits of the inflation rate in the Eurozone, around, on the average, around 2%. The situation changed a little bit since the period after the pandemics. Our inflation rate for a couple of years has been twice the inflation rate of the European Union, Eurozone, excuse me, and this is something that worries me. But that's a different issue. So let's remind ourselves when we talk about the... Here, no? Okay. When we talk about the challenges, where do we come from? What is the environment? We all know that over the past couple of years, central banks have been faced with an unprecedented sequence of shocks, like global pandemic, geopolitical turmoil, wars, and surging commodity prices. These shocks fueled inflation around the globe, and we can see the inflation rates in different countries, different areas. So this is the first slide. Sorry. Okay. Now the other way. Okay. So what were the challenges for policymakers resulting from these shocks? They reacted with one of the most synchronized tightening cycles in decades. Major central banks, we know that they increased the policy rates by more than 400 basic points within a year. This applied also to the Western Balkan countries' economies, which responded swiftly. And the tightening was quite swift, aimed to anchoring the expectations and limiting the second round inflation effects. So now let's turn to the monetary policy undertaken by the National Bank of the Republic of Macedonia. It doesn't differ much from what other countries did. It was like, you know, like a playbook. First line of defense were foreign exchange interventions and rate hikes. We managed to implement a very comprehensive response, integrating monetary policy, foreign exchange policy, and macroprudential measures. The key goal was to balance inflation control with exchange rate and financial stability. We faced very specific challenges, given that we are a small and open economy, and we're highly import dependent. Inflation, as elsewhere, accelerated in late 2021, and the first pressures appeared in the foreign exchange market, which forced the, let's say, the National Bank to intervene with the reserves, having in mind, as I mentioned at the beginning, that our main anchor is the de facto fixed exchange rate of the domestic currency dinar to the euro. In order to, let's say, keep the parity stable, we spent around 15% of the total foreign exchange reserves. Thankfully, they were quite at a comfortable level, so it was not a problem. Next, speaking about this first line of defense, we come to the rate. The central bank raised the policy rate from 1.25% to 6.3%, with tightening reserve requirements for the bank sector. And also we used communication in order to manage expectations about inflation. And the result was positive. Markets stabilized with strengthened confidence and declining inflation and inflation expectations. So the second line of defense were macroprudential policy measures, including the counter-cyclical capital buffer, which was introduced in 2023 and was gradually raised to 2%, which strengthened the bank's resilience. In addition to this, we implemented borrower-based measures to maintain lending quality and mitigate credit risks. As elsewhere, we witnessed, let's say, dynamic increase in terms of prices of apartments, flats and houses, which have increased significantly during the last few years. So now, here, as you can see, we cite the ECB research, which underlines that higher capital buffers and tighter borrower-based measures complement tighter monetary policy when inflation is above target, which is a lesson that we firmly embrace. So this is now we turn to communication and transparency, which also is an important ingredient in terms of disinflation. So the communication was clear and proactive. transparent. The rationale for both tightening and cautious normalization was consistently explained, which enhanced credibility and stabilized market expectations. So where do we stand now? To use the phrase that we are still not out of the woods. Inflation in Macedonia has eased from its peak. In 2022, the average inflation rate was 14.5%, let's say close to 2 times higher, as I mentioned, compared to the Eurozone. But this inflation was incomplete. As elsewhere, we experience persistent core inflation, particularly in services, which remained elevated around 4% in Macedonia and in the Western Balkans. Here, I'd like to make a short diversion to, let's say, explain my point of view about core inflation. You know, what we use as, let's say, measure for core inflation when you subtract food and energy prices, some countries let's say, subtract prices of tobacco and alcohol, etc. This is a mechanical, let's say, computation of core inflation. My understanding of core inflation is what we call underlying inflation. And as you can see or compute R star, natural interest rate, you can't compute underlying rate of inflation, which is due to the, let's say, the distribution of value added between labor and capital, this eternal struggle and spiral between wages and prices. And we see an interesting development in the region, you know, demonstration effect between countries and let's say some parties in these countries, like trade unions, etc., is very high. They use comparisons, you know, when let's say Bosnia and Herzegovina increases the minimum wage, which has become a tool to, or in the hands of the trade unions to press for higher wages. You know, the news comes instantly, and the demands for higher wages or increases in wages they are instantly, which does not help the monetary policy and normalization of inflation. This has been a reason. I mean, this increase in minimum wage last year has been one of the reasons that inflation in Macedonia picked up again at the beginning of this year, which is reflecting, let's say, as I said, global commodity prices and sticky core inflation. Now, take a look at this number that we have witnessed persistent wage growth, 14% nominal and 10% real during the last 2 years, which, as I said, does not ease the job of the central bank. So about one of the phenomenon, and I'm coming close to end my presentation, is the divergence between euro area and central and eastern and southeastern European countries. Headline inflation in the euro area is projected to remain moderate, but convergence to targets in the countries in Central and Eastern Europe and Southeastern Europe is slower and uneven, which has been recorded in the IMF Regional Economic Outlook published recently. Well, what are the policy implications? A prudent and data-driven approach remains essential. Where inflation remains stubbornly above target, monetary policy must continue to account for the asymmetry of risks, especially where robust wage growth could spill into higher service prices, and in appropriate stance could de-anchor inflation expectations and undermine hard-won credibility. So I will skip one and go to the last slide. What are the lessons for the future? One proposal, that we should unfortunately expect more volatile inflation as we face more frequent supply shocks and less elastic supply. We should be cautious when deciding to look through supply shocks. We should be leaning more forcefully against inflation. It will be necessary to prevent transition to a high inflation regime. It's always useful to strengthen analytical capacity to better assess the nature and transmission of supply shocks, and adopting a data-driven, meeting-by-meeting approach, by the central banks, until reaching the stable inflation regime, as purely forecast-based policymaking is less reliable in times of extreme uncertainty. One last point is that I think that we as central bankers will be, in the future, will be faced with challenges, and we are talking about challenges on our independence. Independence of the central bank, as you know, has in some countries has come under questioning, in some countries under attack. The dynamics in, let's say, fiscal policies and the challenges that the governments are being faced with aging of the population, maintaining the welfare state and services will exact the pressure on the policy of the central bank, which will have to, let's say, decide between some consistency and flexibility in the future. Thank you very much.
Thank you very much for all this vast expository on Macedonian economy, especially in the financial market. If you will accept, I would like to have questions immediately after any presentation, because it's much more words and communicating directly. So if there is any question for Governor of Macedonia. Yes, Piroshka.
Thank you very much. The question is, what explains this very high wage growth, which is behind the persistent population, beyond trade unions, ranks, and whatever? Is it demand, labor demand,
Okay, from the labor market point of view, we are countries of immigration. So, you know, young population emigrating in Western European countries tightens the labor market. Second, populism of the governments. You know, in the fractured societies and the fractured political systems, you know, the Juncker, Jean-Claude Juncker saying that we all know what we need to do, but if we do that, we're not sure that we will be re-elected. So this is not a pure economic issue, it's political economy issue. You know, the third is what I call demonstration effect. You know, and there is a lot of noise. For example, in our country, when, let's say, the government of Albania decides to increase the minimum wage, there is a manipulation. You know, they, for example, now, the announcement that they will increase the minimum wage to 50,000 leva, it's a gross wage. So net wage in our country is being compared to the gross wage in other countries, and they say, look, we're at the bottom of let's say, of the scale, compared to neighboring countries. And, you know, there is this issue of money illusion. For example, I was almost, I don't know, not kill this strong word. Once on national television, I used Eurostat data on purchasing power parity of the minimum wage in Europe and the region. And if you compare the present minimum purchasing power parity of minimum wage in Macedonia, it is higher than compared to 8 countries members in the EU. 8 countries members in the EU have lower purchasing power parity of the minimum wage than Macedonia, like Greece, Hungary, Bulgaria, etc. But you know, people are just fixed with nominal, let's say, categories. And of course, as I said, it doesn't make our job easier.
If I may ask a question, because I got interested, you said that you have kind of currency border arrangement, fixed exchange rate regime since 1996. Lithuania was in currency border arrangement until it joined Euro area, so since 1994. And one of the reasons why you've been able to keep the arrangement for 30 years already fixed, you said it's inflation being at more or less comparable to the countries with which currency you have a peg, in a way. But having seen this high growth of wages, this, which you explained, will convert to higher levels of service inflation. How would you be able to keep the inflation level at the level of the, so to say, pegged currency, on what would act as a compensation for higher service inflation?
That's why I said I'm worried, and this is a new development. This is for the last couple of years. You know, the nominal and real increase in wages, and it adds to real appreciation. You lose competitiveness. You lose some, let's say, low labor cost industries like textile industry, etc., because you know they will become expensive for foreign buyers, etc. So it is a real problem. But you know, we had a private conversation with you, my colleague. Each country, we all know that each country that started with transition, you know, and countries at a lower level development compared to the levels, average, let's say, incomes and price levels of the European Union, you need to close a gap. Convergence is necessary, and we are talking about a country. My country is, has been for 20 years now a candidate country. It's a different issue why we haven't started yet negotiations. So real appreciation is inevitable, but the issue is how fast will you, let's say, pass through that process of real appreciation. And I always compare my country, Macedonia, with our neighbor, Bulgaria. Bulgaria has been a member of the European Union since 2007. Take a look at the income levels and compare it between the two countries. The purchasing power of minimum wage in Macedonia is higher than the purchasing power in Bulgaria. The purchasing power of average wage is higher, and still, and this is something that puzzles me, Bulgaria has 50% higher GDP per capita compared to Macedonia. So it speaks about some structural problems of the economy which should be resolved in the future. So my point was that the real appreciation in our country is faster, and it doesn't follow the developments or increases in productivity, which is not good for the economy in medium and long term.
If I can have one question, but very short. Is in your projects to change the exchange rate? Because a small economy as Macedonia, in this very fragmented economic area, which are Balkans, composed by small economies, which all have free exchange rate and different kind of currencies, some their own currencies, some they have introduced a European currency like euro. And in this fragmented economically area, you have this fixed exchange rate. How worth is for Macedonia? Are you keeping this or?
This is a good question. You know, until 10 or 15 years ago, there were voices in the country who would, let's say, you know, exporters, that their exchange rate is appreciated, so it should be devalued, etc. And now there's a consensus. Nobody mentions that any need for changing the parity. We're talking about the parity of the nominal exchange rate of the national currency to the euro, and the consensus is that we should do not touch that. And I think, I subscribe to this because any change in parity would cause major problems and not solve anything. Because part of the economy is euroized, any change in parity would do damage to balance sheets of banks, of companies, of households, without any positive results. But this determination is a strong message to the central bank and to the government with the fiscal policy to be aggressive in disinflation and keeping the inflation very low in the medium term, as I said, within the framework of the inflation rate in the Eurozone.
Thank you. If there are no any more questions, we are following our agenda with our friend, member of our constituency, Mr. Shilunka. So, floor is yours. Thank you.
First of all, I'd like to join my colleagues in congratulating the bank on its milestone of 100 years celebration. And as the Prime Minister said this morning, it's looking back, you cannot not avoid looking at the history of the country itself. And there's nothing wrong in looking back. There's a lot of lessons to be learned. I'm proud of certain things he did right. So it's the time of really looking back. Of course, we should be looking forward, forecasting and so on, but in a celebration like this, I think I don't see anything wrong looking back. It reminds me of my own country, where the central bank was set up a little bit more than 50 years ago, in 1968. Just 2 years after independence. And the real independence came when we unpegged from sterling. Being an ex-British colony, we unpegged from sterling. After all, it was a weak currency. It was devaluing in the middle of the 60s. But however, the wise decision, because after all, I would like to talk about stability and how, in my own experience over time, I saw shocks and crises being addressed. And that was the first time where my own experience was in 1971, when the Bretton Woods system collapsed. And from a fixed exchange rate, we went to a floating, and everybody was chaotic. But we had a very wise governor, loaned by the IMF, who pegged the Maltese lira, our currency, to a basket of currencies, trade-weighted in real time, according to our trade. Mostly were our partners in the EU, who are today Germany and big countries and so on, and also the US dollar. And that saw us for a very long time until we became members of the EU in 2004. It saw us in very stable exchange rates. I mean, relatively speaking, because all the exchange rates were changing all the time, currencies. But it also, unlike many other Mediterranean countries, neighbor of ours, we didn't have relatively high inflation. So we didn't need to devalue that sort of pattern where you have high inflation, you devalue and you bring in more high inflation. So it was quite a stable currency and a stable exchange rate. And now obviously this stability is permanently enshrined by being members of the Euro system. Another crisis came straight in my face when I decided during my sort of retirement to go out for politics for the European Parliament, got elected there in the Economic Committee in 2009. And that meant that it was just after the global financial crisis. Enormous problem, you know, because it brought with it the global recession, and then which demanded a lot of funding and meaning bigger deficits for countries in order to give it all, in order to compensate for that credit crunch, which again led to this sovereign debt crisis, and for Europe meant the euro crisis. And being in the European Parliament, it was like a factory, turning out legislation on a daily basis, working in that committee, setting up the first institutions for stability, the ESRB, and the three authorities, EBA, the ESMA, and the IOPA. They were all set up by the Parliament at that time, and led by a myriad of financial regulations. In fact, today, we've been saying this all along, but today the EU is also conscious, because of its competitiveness has come to the fore, that maybe we should have a second look at this cocktail of regulations and see where it can be simplified. Because after all, they are a burden, and you know, on a global basis, they hinder competitiveness. I wouldn't use the word deregulation, but definitely there are ways and means where one can simplify this myriad of regulation. Of course, they stood as well in bad times. I mean, during the pandemic, we were very lucky to have those regulations in place, and therefore, you know, the banks went through it without any issues, at least at the European level. And any crisis, whether in Switzerland or in the States, did not touch the European Union. I wouldn't, of course, we had to change the treaty in order to allow us to bail out countries during the euro crisis. And then we switched with the Cyprus instance into the bail-in to this very day. At that time, we didn't even have a roadmap to reach that. But I wouldn't touch on the fiscal, because here we have with us the ex-president of the Eurogroup, my friend Mario here. I'm not asking him to go into it, but you know, I can skip this fiscal part. So what about the ECB? Because that's more the topic of today. What are my impressions and what I have learned there over the last 5 years? After being finance minister, then after 8 years there, I was appointed governor at the Central Bank of Malta for the last 5 years, and my term ends at the end of this year. I think what I've learned mostly is the question of maintaining credibility. So I don't think I'm going to shock you, but I think what I learned is that monetary policy can actually work. Obviously, one has to work very hard to obtain it. It won't go on autopilot, definitely for sure. And it was a very interesting experience looking over the 5 years, because we've seen a little bit of everything. Demand shocks, supply shocks, negative interest rates, high inflation, two-digit high inflation, you know, all over a period of, you know, of 5 years. And we can look at it in parts. The first part, which I sort of experienced at the beginning of 5 years ago, where I found the euro system being in negative territory, negative interest rates, and also a little bit of deflation in some countries who are scared of it. The problem with deflation is that it's more difficult to tackle than inflation. Let's put it this way. All our orthodox tools are set for inflation, when in the face of deflation, you know, we talk about a lot of, you know, but still highly controversial. You have to pump so much money and quantitative easing and so on. Still controversial. But one thing for sure is that low inflation is stubborn, very stubborn. It won't budge so easily. And that's why later on we changed the framework where we treat rates of inflation below 2% as dangerous or as demanding attention, perhaps more than if it's over 2%. So the symmetrical target, which came with the change in framework, was, we updated the framework in 2020, was for this reason where we introduced the the symmetric 2% inflation target. And then came the pandemic, another enormous, I mean, it's a watershed. I mean, you refer to it as like the Second World War. Were you born before or after the Second World War? You talk about before or after, because the pandemic was really a watershed, which was clearly a negative demand shock, which required, it was a severe one, lowered our GDP and pushed inflation into negative territories as well. The Eurosystem balance sheet expanded from, and it scares people to read these numbers, from 7 trillion to about 7 trillion, which was an increase of 2.3 trillion compared to the end of the previous year. And then, inflation started to pick up because the war, Ukraine came into the picture, Russia, and the energy shock and the global supply chains. And here we did have a dilemma, because all our toolkit was meant for a demand shock, not a supply shock. What can you do? If the core inflation is benign, if prices have exploded just because of one person who shut the supply and prices shot up, and everybody was saying, you should be dealing with it, come on. But we were convinced we had to wait to see how the business world, how the unions, trade unions, would react. Would they be patient and wait for it? Because it was a big disaster for that to happen. And we had to be very cautious before we started, raising interest rates. It took a while, excuse me, and we were highly criticized for that, because they expected us to be quicker, but I think we're quite, sorry about that. Finally, when core inflation started going up, then obviously we reacted, started tightening, and we raised rates, I believe 6. First of all, we signaled to end the net asset purchases, to start with, under PEP. And I think it was July of 2022, marked the beginning of the tightening phase 1, because inflation had peaked to 10.6% in October of 2022. And between July 22 to September 23, the deposit facility rate went up from -0.5% to 4%, a very steep hiking price. Obviously, when that's passed, of course, we're accelerating the pace. We reversed the process, but not because there was a cycle. I mean, the market was saying, but aren't you going to, lower another time so that you will complete the cycle? I can assure you, we don't have any cycles in mind because these types of shocks and uncertainties are such that you don't have sort of like, in fact, we have abandoned the forward guidance and go by meeting, data-driven, it becomes a cliche. But the real truth is there's no such thing as a traditional cycle to go by. So at the moment, we have a balance between all these protections and tariffs and shocks, but at the same time, a resilient economy, not just at the European level, but even globally, which is withstanding these, and there's a balance. And if we're close to the 2% target, why mess up? I mean, as the Americans say, if ain't broken, don't fix, something like that. So this is a situation we are in. We've learned a lot, so, but perhaps, I'll deal with that when my colleagues speak or if there are questions.
If there is not any question, I will make a short question. Short question. Malta is a small economy. It is better now in the Eurozone or it was before having its own currency? Can you make just in a short, not a very deep explanation?
The shortest is yes.
You are better now than it was when you have your own currency.
The shortest is yes. Definitely, when you realize that it's a question not as much as the toolkit, as much as the trust and credibility. Of course, your own credibility is important, but then if you're in a family and the credibility of the family is good and strong, then it's better. So definitely a small open economy, as far as monetary policy, there's more credibility, your rating, the way it's seen by outsiders. People living somewhere in the United States, they wouldn't even know whether Malta is in the US or outside, in fact, there are 3 Maltas in the US. I'm joking because from afar, an investor or, wouldn't know the difference. So if you're in the EU, I think people will pay attention.
Very diplomatic.
Yeah.
If there are no questions, we are going on with our friend from the Bank of Lithuania, the Governor Simkus, to have the presentation about challenges that your country has being part of the Eurozone and trying to have this role as central bank.
Thank you. And to begin with, on behalf of Bank of Lithuania, I want to extend my sincere congratulations to the Bank of Albania with 100 years anniversary. And so wishes and another 100 years should be not enough to continue working with all the professionalism and trust you have in the central bank activities. In fact, after listening Armenia's North Macedonian, and then Edward elaborated on the euro area's behalf, I would say I would tend to skip all this because there's going to be a little bit of a repetition, and instead of retrospective view onto the structural challenges, I would tend to look ahead. And my point that monetary policy has not been simple, as it was very well explained by colleagues, and it will not get simpler. And so there are a lot of structural challenges, and I will focus only onto one, that I believe will stay with us for at least in the medium term, and this is rising sovereign debt and what it means for central bankers and interest rates. So, I mean, it's very well-known fact that monetary policy has been shaped in recent years, I would say decades, with a number of structural forces. Population, aging population, demographics, low productivity growth, climate-related risks, intensifying geopolitical tensions. And the point here that these are not temporary disturbances that you can look through. They will stay for us. And this is the scene in which monetary policy makers, central banks, but also all the rest, all other policy makers will be setting their policies. Next. For decades, Europe relied on a relatively benign geopolitical environment. And this is no longer the case. War in Ukraine unjustified Russia's invasion into Ukraine, but even broader, we have a strategic rivalry between the economic powers. And this marks the lasting shift to a world where security is no longer granted. It cannot be taken for granted. And it's unrealistic to think that the war in Ukraine ends or in a couple of years we can return to the old normal. It's unrealistic to believe or to expect that. And this new reality has very clear fiscal implications, right? So to protect societies, to preserve environments in which companies can invest, can create jobs, can function, countries, governments need to invest first into defense, of course, but then into the energy security, and second, into the critical infrastructure. And they need to do it now, ex ante, and not then the crisis emerges. So, and these expenditures are not just a mere add-on, they are precondition for economic resilience. And in other words, I broadly explain what, to a large extent or broadly, is the European strategic autonomy. But the security and resilience, of course, comes at cost. And first, if you have higher structural spending, if it is not matched by higher revenues or reallocation, this means higher deficits and higher debt ratios in countries. And of course, this has consequences. First, for decades, nominal and real interest rates declined, driven by demographics, low productivity growth, and strong demand for safe assets. But looking into the future, given what I have said before, we cannot extrapolate this trend. And rising debt levels and more frequent geopolitical shocks can test investor confidence and push term premium upward. Second, if we have high rising debt levels in such an environment, markets more and more will differentiate among countries, sometimes abruptly. And recent episodes, including advanced economies, shown how quickly the doubts about the fiscal sustainability or policy consistency can be reflected in yields and spreads. And third, this reinforces the importance of fiscal discipline. And if I refer to the European Union, the credible Stability and Growth Pact implementation, meaning that clear rules that ensure sustainable public finances anchor market confidence and preserve room for monetary policy to do its job. So what this means for central banks, for central bankers and for central banks, this environment, this new environment. So first, we need to do our job. Our job and mandate is very clear. Our primary objective is price stability. And it's precisely in this context, we have been talking about the central bank independence, and that's exactly what determines that we ensure this central bank independence is sticking to our mandate, keeping inflation expectations anchored. And this is the most valuable service we, central bankers, provide to the governments, to our societies, to our nations that operate in a higher debt level environment. a predictable nominal environment. Second, we must be ready to safeguard the smooth transmission of monetary policy. In the euro area, instruments such as transmission protection instruments are designed not to subsidize unsound policies, but to counteract unwarranted, self-fulfilling market dynamics that threaten the singleness of a monetary policy. And third, we need for clear division of labor. Fiscal authorities do their job, ensure security, resilience, social cohesion. We do our job. This is price stability. And finally, we must continue to do what the recent history shows we can do. Be agile, be adaptive. Last 15 years, starting with global financial crisis, then euro area sovereign debt crisis, then pandemics, then energy and energy prices surge and inflation surge because of the unjustified Russia's invasion into Ukraine, and as nicely Edward explained, like closing a tap of energy resources. So each time central banks developed and deployed new tools within their mandates that help to stabilize expectations and safeguard monetary policy transmission. So to conclude, the message I want to leave is that we're going to be functioning in a more hostile world, and this is a long-lasting challenge. And it is very likely that different interest rate environment we're going to have, different from the one we knew before. And with credible fiscal policies, clear focus on price stability mandate, and the capacity to respond to market dysfunction and fragmentation when needed, central banks, I'm sure, will remain what they must be: anchors of stability, enabling sustainable growth in an uncertain world.
Thank you. It was like a statement for what the central bank will be when they will be part of the ECB system. So they look much more stronger, more influential in their economies, bringing back home also part of the power of the mother ECB. So it was very encouraging for other countries which are looking forward to be part of this system.
I'm absolutely sure this is the case. So one thing is that one of the biggest advantages that the ECB gives for smaller central banks, I don't like term a small and open economy or smaller central bank. I like saying this is a compact economy. Why? Because in a compact economy, you can be agile, you can adjust quickly, you can adapt quickly, and that's what's happening. I was in Albania 20 years ago. I was talking to governor. In 20 years, this development here is enormous. You can't recognize the country. And I know people who visited Lithuania, 30 years ago, they were telling the same story. So the transition is that quick. Can I say this, Governor? But the governor himself told me that if he goes to the part of Tirana where he has not been the last 3 years, he can't recognize. The same was for me in Vilnius. So, I drifted away from the question, but one of the biggest advantages, so that we function in very clearly defined Eurosystem into very clearly defined Eurosystem rules and regulation, and this gives a very big boost to the independence of the central bank in each of our countries. So this is one thing. Second thing is that in the decision of the Eurosystem, each central bank, no matter how big or small it is, has an equal vote. Yes, like from time to time, your vote is not counted because there is a rotation of voting, but still you sit and you vote equally. And second, Governor from North Macedonia was explaining about almost fixed exchange rate regime since 1997. I am from the country which had a currency board arrangement from 1994. And there were quite many countries in Europe which had currency board arrangements or kind of a currency board arrangement. And luckily, they were in Europe, where we have Euro area and the Euro system. Because history is not rich in successful exits of currency board or fixed rate arrangements. So becoming part of the European Union and then of the Euro area is very nice strategy to exit the fixed rate regime. So it's a huge advantage for the countries as Baltics were or as the Central and Eastern Europe is.
Since on the topic, in the Euro system, you have the same rights and the opportunity to speak as much as Germany, Malta, or Lithuania, or whoever. But then you have the same obligations. Every day written procedures coming, and we have to cope with them just as Germany, France, and Spain can have. Of course, it's not an impossible task, but it's demanding, definitely, on, especially when this stuff is modest.
Short question. How can a country that uses euro as their own currency claim that they have monetary policy? Don't you import monetary policy from Frankfurt?
I cannot say it's a good question because it's a provocative question. The point is that you think that you raise the question as an outsider. So, because Euro area in euro is my currency, is our currency. I set the monetary policy. And that's the point. It's not them somewhere else. It's us as a family, as a group. And I wish very much. So actually euro is, so we talk about European Union and the free movement of labor, capital, goods and services. But then when you, so to say, dig into how really it is functioning, not theoretically, but really, you see a lot of impediments in different areas. And actually, Euro system is one of the biggest successes in European Union. And this is exactly how, or the star we should move to in order to have European Union like more as a union and less as a bunch of countries which in a way adjust some regulations to their national laws with different national discretions. Euro is our currency. Monetary policy of the Euro system is our monetary policy.
We are going to listen the opinion of our last speaker, which is the ex-governor of Portugal and also member of the board of the ECB, a very distinguished friend of Albania because we are in the same constituency. And I would like also to listen how he's thinking about Europe because he is, let's say, one of the first countries entering in the Eurozone. So, thank you.
Thank you. Thank you for the invitation. Congratulations. I congratulate Albania and the Bank of Albania in the person of Lulieta and the governor that is in the room. 100 years is certainly something for you to celebrate. The panel is on monetary policy and challenges. One of the initial challenges for monetary policy in Europe, just taking on the answer of Gediminas on your question, Governor, is if we are an optimal currency area or not. And that relates to the way markets work. Monetary policy operates through instruments and credibility. And monetary policy is always a very active game because we work with a final objective of having anchored expectations for inflation. Whenever expectations de-anchor in the medium term, monetary policy is in danger it's a little bit hectic because we take decisions today to show that we are credible for an event that will occur in 2, 3, 5 years. And everything that disrupts markets creates challenges for monetary policy. If we want to find out what are the present challenges, you need to look at the economy and see where markets are being disturbed. And I can name 3 main challenges: trade fragmentation, fiscal deficits, and asset prices. I'm not mentioning really bubbles, but asset prices. These 3 markets, if we want to call them markets, can place challenges to monetary policy. Trade fragmentation is something that we are now facing in reality, mainly through tariffs. Tariffs are taxes. Taxes cause a perturbation to markets. They shrink the economy. They are a problem. The response to tariffs operates through markets again, and that depends on the elasticities and on market power. There are some international trade markets that can be monopsonistic if demand has a great power in that market. They can be monopolistic. All markets work differently. So it's very difficult to predict what this fragmentation will mean given the variety of markets we have. But there's one thing that it's for sure. We will be reoptimizing. We will be changing our behavior in these markets, and that maybe could be avoided, especially under the wonderful period of globalization, under Bretton Woods and multilateralism that offered probably the most exciting and with the most prosperity levels that the world experienced ever. This has been questioned, and this is a challenge to monetary policy. Why is that? Because persistent inflation may occur on the basis of this constant reoptimization that firms and markets will be doing, and this may de-anchor the expectations of prices. So for monetary policy, this trade fragmentation is not good news. Fiscal deficits, it's the same sort of story because, of course, they create risks of fiscal dominance. They may raise concerns about the credibility of monetary policy to operate in such a dominance of fiscal policy environment. And really, deficits have been soaring in most economies. The clearest example being, of course, the United States. If you add up the deficits of the United States since 2010 to 2030 with the forecasts by the IMF, you get a number that is 153% of GDP. This is huge. The numbers for the Eurozone are less than half, and still we are concerned. They had something like 69%. So this is, again, something that poses challenges to monetary policy. We want fiscal policy, as all economic policies, to be counter-cyclical. Gediminas has mentioned a few examples of how fiscal policy is good to operate in the near future. in the business cycle, we want it to be countercyclical, and we've been experiencing episodes that fiscal policy is really pro-cyclical, and that makes monetary policy to be more forceful and stronger than probably it will be ideally without this pro-cyclicality coming from fiscal. Well, asset prices, being the equities or the housing markets, they place, of course, challenges to our economies. We need cooperation. The instruments of monetary policy alone are not enough. We need cooperation with other instruments, like, again, government and regulators alike. We need to have an eye on that if we want really to understand all the challenges of monetary policy. But there are also positive ones. Artificial intelligence, it was already mentioned here, it's a boost in productivity. We need to understand that the promises that these may deliver to us, but also the dangers, because there are always dangers of, for example, displacing structurally parts of our labor force. We need to create the conditions for us to cope with that displacement if that exists. We have the means, we know how to do it, we need just to be aware. So overall, I think artificial intelligence is a positive challenge for us. But also a very important market in our economies, sorry, Gadimin, the labor market. The labor market is so much important to the way our economies work. With poor adjustments in the labor market, monetary policy will face big challenges. It's not only because of wages, it's because of the cost structure of firms and the way the economies adjust. And us in the labor market, in the euro area, sorry, benefited, and probably it was a big step towards taking the conclusion that the euro area is actually an optimal currency area. One of the missing pieces for many years was precisely the poor adjustment in the labor market. And we have benefited lately from mobility, flexibility, efficiency in the way our labor markets operate that the Eurozone did not benefit in the past, or at least the countries that were part of the Eurozone. If you go to the 80s and 90s last century, the story behind the European labor market was one of hysteresis, sclerotic adjustments, long-term unemployment, employment adjustments that took a long time to complete. Those contexts made monetary policy much more difficult than recently, when we see long-term unemployment falling, mobility increasing in Europe, within and external mobility we have. I don't know if you know the numbers, but more than 2/3 of employment growth in the Eurozone in the last 5 years. And the Eurozone created 12 million jobs in the last 5 years. 70% of those jobs are held by people that are working in a country different from the one they were born. Foreign-born workers. It's never, ever observed in the Eurozone before. 70. Out of the 12 million, more than 7 million people are working in countries in which they were not born. And then finally, just to complete this picture, we talked about productivity. We talk a lot about productivity, but education is the grease of both productivity and the labor market. And we sometimes think of Europe as the job is done, but it's not. Again, the numbers, when compared, for example, with the US, in the US labor market, 51% of the population has a college degree. In Europe, the number is 37%. It's 14 percentage difference. And this difference is today larger than it was 15 years ago. We are not catching up. Europe is lagging behind in terms of college education. We need to change this because productivity will not increase if we do not have a skilled population and if we don't increase the level of schooling in our countries. And for sure, countries as Western Balkans, Albania, they need to keep up with this as well. My own country, Portugal, we started the 21st century ranking the lowest position in terms of the ranking of schooling in Europe. We were able to change this, but it takes 45 years to complete this change. So it's a very long and slow process. And these are the challenges that I see in the economy that may make monetary policy easier for our countries, because monetary policy impacts, but it's impacted also by the efficiency with which the markets operate. And looking for challenges in monetary policy, we need to look for the way these markets operate. Thank you.
Thank you. Thank you. It was a long and fruitful analysis to make all the macroeconomists to think tomorrow. So if there is any question? Yeah. Yes, Piroshka.
Thank you so very much. That was a very interesting discussion. A lot of insights we learned, I think, well, I learned a lot. My question would relate to the TPI instrument, for which there was a strong support. That's not by everybody, as one understands from the members. So my question is that, isn't there a risk that fiscal dominance will come back in the form of kind of assuming the TPI working, in the sense that governments which don't really have fiscal space issue that, maybe very justified defense, right? But they don't have the fiscal space and they don't do the structural reforms that would finance on the long, as Alfred was, pressing. So in that sense, but the interest is guaranteed by the TPI. So would that be a form of fiscal governance? It's a hypothetical. I don't know. I know central bankers don't like hypothetical, but there is some, thinking about this. Okay.
Yeah. Good question, as usual. Well, an optimal currency area needs backstops. And the TPI is a backstop. One of the problems, and Edward made a long digression over the problems, but I sit at the same table as Robert for already 10 years. So we experienced all these issues. And 10 years ago, 15 years ago, the Eurozone was a very incomplete institution. It's man-made, as Gedimina said. It's a political decision. It was one of the bravest decisions in Europe in the last decades, but it was rather incomplete, and we lacked all forms of backstops. And without a backstop, the financial markets look at us and say, there's something weak there. Let's try it. As you create these backstops, and the ESM, the European Stability Mechanism, is another one, when you harmonize supervision in Europe, the banking union, the steps that we know that we still need to do, the Draghi and Letta reports tell us a lot about what needs to be done in Europe, we reinforce the institutions. And that's something that I must do. Other example is the creation of a safe asset in euros. But we were brave enough during COVID to ask the European Commission to issue in the market a large amount of a safe asset that is backed by the budget of every single European country. And this issuance was very important also to signal to the markets that we Europeans, all Europeans, are there to back that. And that's one signal. Of course, there are no free lunches, and every time you do this, you may also counter-signal that, I mean, there is room to do other things and to enter into a behavior that can lead to some sort of fiscal dominance. There, of course, the remaining instruments in the Eurozone kicked in, and we have the Stability and Growth Pact, we have the rules, we do know. Again, Portugal is a very good example of how you move from a country that was not really knowing how to behave within the Euro to one of the most stable countries in terms of fiscal policy today in Europe. So yes, we can learn, yes, we can know how to do things. So I'm sure that this combination of things strengthen the euro instead of weakening these links that are so important for us. Sorry for the long answer.